Joining us at Post 9 is Rebecca Patterson, Senior Fellow at the Council on Foreign Relations and former Chief Investment Strategist at Bridgewater. Good to see you.
Good to be here.
Put some of this all together, I guess. You know, we have U.S. Economy in general kind of holding up better than the rest of the world through the oil shock. And then we've swung from, thinking we're getting rate cuts to thinking we're getting perhaps a couple of hikes. And now it really feels like that ambiguous middle zone of it's kind of a coin toss plus in the coming months.
Yeah, I mean, you guys just covered it really well. The retail sales, maybe World Cup was part of it, but overall very resilient. The banks are giving us color that the overall economy is resilient, although that bottom cohort's still suffering, but it's not enough to pull the whole thing lower. So, putting a Fed hat on, they don't need to worry for now about jobs. That's back burner. So the front burner's inflation. And while CPI and PPI this week certainly were good news, softer than expected, we have oil prices going back up. We have a lot of question marks about what's going to happen in the Strait of Hormuz. So that's an upside risk. I'd say the one good thing coming around the horizon, it'll be September before we know it, is that you have a methodology change to PCE. That's probably going to bring down that number by 10 or 20 basis points. And so it's a mixed bag on inflation, but I think the big deal is that we're still way over the Fed's target for more than 5 years. And so if you have a resilient economy, you have question marks about the Fed's commitment, despite what Warsh says very resolutely, I think it makes sense that the market is biased towards hikes.
You think they'll actually go? I thought Gary Cohn was here yesterday, and one thing that he said is, reading in between the Warsh testimony, is maybe no hikes, but trim the balance sheet, since Warsh sees that as a monetary policy tool.
Yeah, I think it's good that we're looking at both. It is interesting to me how much focus the balance sheet is getting, because we've heard for the last, 5-10 years that balance sheet changes have a fraction of the effect as an interest rate move. So to get a rate cut equivalent from the balance sheet, you would have to do something pretty material to the balance sheet. And if you did that with any kind of speed, it's going to be incredibly disruptive. Of course, the Fed's not going to do that. So I think balance sheet, if it comes into play, it's a next year story, not this year. So the idea of a rate cut this year, I think, is, unless there's some catalyst, totally off the table. And using the balance sheet in a more material way, I think there's a lot of work that needs to be done before we cross that bridge.
I was texting with Stephen Myron about this, the former Fed governor, and his back of the envelope math is $1 trillion is probably about 100 basis points of front end equivalent. It's what I text people about.
Yeah, well, look, he wrote a really good research report while he was still at the Fed. Lori Logan at the Dallas Fed has done a lot of work on this as well. So there is some really good research that people can put into their AI model and see the kind of scenarios that could happen and what seems realistic. But again, I don't think it's coming anytime soon. I mean, Myron might be right on his math. I haven't done the work myself to know if I'd agree with that.